Okay, good morning, West Coast. Good afternoon, rest of the country. So glad you could join us this day. My name is Jeffrey Tesch. I'm CEO of RCN Capital, and I'm super excited to present a good friend and the master of all data to our industry, Rick Sharga. Good to have you on board, Rick.
Thank you so much for inviting me, Jeff. I'm delighted to be here.
Yeah, great to see you. Just for those of you who don't know, Rick is the Executive Vice President of Market Intelligence at ATTOM Data Solutions. And as a lender in the space, we have come to rely on ATTOM Data for all things real estate related. They've just done a tremendous job of aggregating the kind of information that really powers a lender like RCN Capital. And as a lender, we attempt to provide that information as much as we can to our investor customers, broker partners, correspondent lenders across the country. And that was really the genesis of today's webinar. Rick and I were together at a single family rental conference in Miami, and we got to chatting, and one of the topics came up was, hey, let's get together and share some data and try and educate the masses on what you're seeing, Rick, across the United States today. We also participated in a cooking demonstration. I must say, Rick, your sushi skills were way beyond anything that I thought you had. And if this whole data thing doesn't work out, you always have that to fall back on.
I appreciate that, and the picture of my spicy tuna roll was one of the few things I've done in recent years to impress my teenage daughter. So we have that going for us.
Outstanding. Well, with that said, I'm going to turn it over to Rick, and away we go. Oh, one more thing, folks. If you have questions over the next hour, just put them into the chat box. We're going to leave some time at the end to be able to address those. But super excited to go through this presentation. Rick, take it away.
Thanks, Jeff, and thanks again for excuse me, for inviting me to be here. We're going to cover a lot. We're going to do about a 3-hour 3-hour session in the next 45 minutes or so. So stand by. If anybody would like a copy of the slides afterwards, let us know. Be happy to share those with you. We're going to talk just a couple seconds about ATTOM for those of you who aren't familiar with the company. I'm going to spend a bunch of time talking about what's happening in the U.S. economy, because that's very, very important in terms of what goes on in real estate and real estate investing. We'll take a look at the housing market, some changes. I think we're at an inflection point in the housing market today. We'll talk about what we're seeing in terms of real estate investing in today's market. I'll give you some insights from our numbers and what's going on in foreclosures. Talk a little bit about what we see going forward, and again, as Jeff said, we'll leave some time at the end for Q&A, and that's usually the most interesting part of the conversation. ATTOM is one of the leading providers of data, real estate data, to a variety of industries: the real estate industry, the mortgage industry, insurance, government, and a few other market segments. And we break up our data into a number of different areas, like property data, ownership data, mortgage data, valuations, foreclosures, so forth and so on. This table of data elements has continued to grow since I've joined the company a couple of years ago. And we've recently started to add things like climate change risks into the data. So for anybody who's looking for real estate related data, please reach out, let me know. I'll put you in touch with my colleagues. We have programs for large companies that are getting enterprise level data, and we have products that are aimed at small businesses and individuals as well, who might be looking for local market information. So again, appreciate Jeff giving me a chance to do a little bit of a commercial here for ATTOM, and we'll move into the meat of today's conversation, what you all came here to talk about today. So what's going on in the U.S. economy? Well, if you haven't been paying close attention, the economy, which recovered in a remarkable manner coming out of the COVID pandemic and the government shutdown, has started to show some signs of weakening. The first quarter of this year, we actually had negative GDP growth. The clinical economic definition of a recession is 2 consecutive quarters of negative growth. You can see we had that as the pandemic was declared back in 2020. We had the single biggest drop off in a quarter of GDP in US history, over 31% when the government shut things down, followed by the biggest single quarterly increase in GDP, almost 34%. If you, like me, are sometimes challenged by basic math, I should point out that a 31% drop followed by a 33% increase doesn't quite get you back to where you were, but it's a good start. But to see 4% and 6%, almost 7% quarter over quarter increases after that is nothing short of remarkable, and showed just how strong and resilient the economy was. Inflation is starting to wreak some havoc with the GDP, and we'll get into that in a little bit more detail. But there's a variety of different reports we're seeing on estimates for Q2, ranging from negative to marginally positive, and we'll see where all of this leads us as we go forward. One of the fascinating parts of what we just went through in terms of the COVID recession was its immediate severity and the rapidity of the recovery. We lost about 22 million jobs in about a week, which is just a number that is mind-boggling and it's off the charts. But there are two things about this recovery that are very, very different, about this recession that are very, very different. One is the focus, the concentration of job losses. In most recessions, you have job losses across the board: white collar, blue collar, government, entrepreneur, manual labor, professional managerial, everybody gets hit. This particular downturn, the services sector got just manslaughtered. We lost millions of jobs in retail, restaurants, travel, tourism, hospitality, entertainment. Those markets were just hit extremely hard, whereas a lot of other areas weren't hit hard at all. So the concentration of job losses in a single sector, very, very different from most other recessions. And the other thing that's been very, very different is how quickly those jobs have come back. We're basically where we were before the recession hit in the jobs market today. So job creation, the unemployment rate coming down has been spectacular. To put this in context, during the Great Recession, unemployment peaked at a little over 10%. This time it peaked at a little over 15%. In the Great Recession, it took us a full decade to recover the jobs that were lost. The tail end of the Bush administration, the entirety of the Obama administration, and the beginning of the Trump administration. That's how long it took us to get all those jobs back. In this case, it took us about 2 years. And jobs are still looking for people to fill them. There's about 1.5 to 2 jobs available for everybody who's looking right now. And because of that, it's gotten more expensive to hire people. So wage growth has been particularly strong over the last year as employers have been looking for employees to fill these open positions. So you'd think everybody would be feeling pretty good and pretty optimistic, except that inflation has been running even hotter than wage growth. We're at the highest level of inflation we've been at in 41 years, 8.6%. And I believe, and a lot of the economists I talk to also believe, that the 8.6% inflation actually understates the severity for most households. If you look at what the government reports about inflation when it comes out with these reports, it excludes things like food and fuel, food and energy, because those segments are considered to be too volatile. Well, if you look at food costs, they're up over 10% on a year-over-year basis. If you look at your gas prices, they're up somewhere between 40 and 50% on a year-over-year basis. For people at the lower end of the wage scale, those necessities take up a much higher percentage of their monthly take-home pay. So those folks are actually suffering much more from the price increases that we've seen than what you would normally see from that 8.5% inflation rate. But the bottom line is inflation is running rampant, and the Federal Reserve is doing what it can. We'll talk about their actions in a second. What's also been interesting as this has gone on is if you would look at numbers historically, you would see that our savings rate went through the roof, almost the highest it's ever been during the pandemic. So while the government was sending out stimulus checks and had enhanced unemployment benefits, people were actually putting that money away and saving it. And spending went way down. Spending has since come roaring back. We're seeing consumer debt increase, credit card usage increase, and savings have gone down to below where they were prior to the pandemic. What's really interesting about this from my perspective is that consumer spending very often goes hand in hand with consumer confidence. And in fact, that's not what we're seeing right now. The consumer confidence, and these are two indices that are published. The blue bars are the consumer sentiment index. It's published by the University of Michigan. It's the one that's most frequently quoted in the press, and its most recent numbers have been historically low, way below what we would hope coming out of this pandemic. The dotted line you're seeing here is the U.S. Economic Optimism Index, and it's also running at historically low numbers. The reasons for that are multiple, but the two most commonly cited reasons are inflation and geopolitical unrest, specifically the war in Ukraine, the Russian invasion of Ukraine. So it's an interesting market where consumer confidence is low and consumer spending is high, and I really do wonder how long that dichotomy will exist. This is important from an economic standpoint because what most people don't realize is the U.S. economy, that GDP number we started talking about, is comprised 70% of consumer spending. So if consumer confidence drops and causes consumer spending to go down, we could find ourselves in a recession just due to a lack of consumer confidence in what's happening in the market today. So the question comes up whether or not a recession is inevitable. This is a chart from the Fannie Mae Economic and Strategic Research Team. They are forecasting a moderate recession in 2023. Since they put this report out, we've seen Deutsche Bank come out with a similar report. JP Morgan has said we should brace for a hurricane in the economy, although we should be hopeful that it won't be as bad as some of the projections are. Bank of America is now calling about a 60% chance for a recession next year. And again, a recession is 2 consecutive quarters of negative GDP growth. And you can see toward the tail end of next year that the GDP growth does go negative based on Fannie Mae's forecasts. The reason that a lot of people are projecting this is because of the Federal Reserve's actions. The Fed does need to get inflation under control. That's one of their prime motives, prime reasons for being. And this chart also from Fannie Mae shows what's happened when the Federal Reserve has taken action in cycles past to try and get inflation under control. So this goes back to 11 prior cycles dating back into the 1950s. And what it shows you is that every time the Fed has raised the Fed funds rate to get inflation under control, 8 of the last 11 times we've entered a recession. The 3 green arrows are the exceptions to that. And in those 3 instances, the Federal Reserve raised the Fed funds rate preemptively in order to keep inflation from getting out of control. In all 3 of those cases, they raised the Fed funds rate and we did not have a recession. If you look at the 8 red arrows, that's when the Federal Reserve raised Fed funds rate in response to inflation getting very high. And that's exactly what we're looking at in this cycle. You can see that red dotted line. That's consumer price index, the rate of inflation. And the Fed is now acting aggressively to try and get that under control. So every time they've done that since the 1950s, we have entered into a recession within 12 to 15 months. And I'm of the school that believes we will definitely find ourselves in some sort of recessionary market sometime in 2023. How severe it'll be, how deep it'll be, how long it'll be, really good questions. Nobody really has an answer for that. But the more aggressive the Fed gets trying to get inflation under control, the higher they have to raise the Fed funds rate in order to get spending down and slow the economy, the more likely it is that we're going to see ourselves in a recession. And Chairman Powell even indicated that during his last Fed funds announcement, where he said They need to get aggressive in getting inflation under control, even if it does potentially lead to a recession. So I think we're starting to get some forward messaging from them. One of the things this has resulted in is mortgage rates going up in a high inflationary period, in a period where the Fed tends to raise the Fed funds rate. We do tend to see mortgage rates go up, and this has had an effect to slow down the housing market, which candidly is one of the things the Fed wanted to do. So what is going on in the housing market? Well, the market started out the year fairly strong, but we've seen now 5 consecutive months this year and 10 consecutive months overall of lower existing home sales. I think this is something we'll continue to see as we get through the rest of the year. Now, I want to point out what I'm saying here is not talking about a calamity, not talking about a disaster in the housing market. In May, the annualized number of home sales, existing home sales, was still at about 5.4 million annual units sold. So we're not talking about a weak housing market. We're just talking about a housing market that is going to show something of a decline from where we were last year. I believe this is happening due to affordability, and there are some demographic factors that will continue to keep demand relatively high, notably the millennial generation. The largest cohort of young adults in history is reaching home ownership age, and that will continue to put some demand pressure on the market and keep the numbers from plummeting overall. New home sales have fallen even more quickly. May, we saw an increase on a month-over-month basis compared to April, but still showing that on a year-over-year basis, we're selling less new homes than we've been selling in the last year. And we're seeing housing starts adjust as these numbers come down. So we were seeing stronger housing starts. We were seeing more building activity going on. But the builders have scaled back a little bit over the last couple months, which is good because they got caught with way more inventory than the market would bear during the Great Recession, and they're trying to be careful not to have that happen again. Our friends at Altos Research keep track of inventory on a regular basis. I like their numbers a little better than the National Association of Realtors because they're more real time. NAR will give you a month's worth of inventory. Altos basically takes a look at what's on the market today. And what you can see is we're starting to see, after a steady decline over the last few years, we're starting to see increases in available inventory. So about a 6.2% increase last week, over 444,000 homes across the country available for sale. That sounds interesting, but in a normal market, we'd be looking at closer to 1 million units. So even though we're seeing the inventory levels increase a little bit, we're still running at about half the level we normally would. To put that in context again, in a normal market, a market with equilibrium, we'd see about a 6-month supply of homes available for sale. Today, we're looking at about 2.5 months. So we're running at about a third of where we would normally be. Entering the Great Recession, entering the financial crisis and the housing market meltdown, we had almost a 13-month supply of homes, so twice as much as we'd normally have. And that was one of the reasons we saw home prices collapse the way they did during that period of time. Simply too many homes for the buyers that were available. This is a chart I kind of follow. It's from a website called Calculated Risk, and it shows new home inventory. And the 2 points I wanted to make here is the red area is new homes that were completed and are available for sale. This is the lowest number that has been charted since this number began to be recorded in 1973. So homes completed and available for sale, very, very low, less than a month's supply. The blue area is homes that are under construction. And we're seeing many of these homes being sold while they're under construction, or even in the green area, which is basically when a permit's been given, but before the home has been begun in terms of construction. So the builders are selling a lot of stuff as they're building it or as they're getting ready to build it. One of the things to watch as we go forward is contract cancellations. We're seeing a little bit of an increase in those that the builders are reporting. But not a huge amount right now. But I do think we'll see the builders continue to keep housing starts under control until they're fairly certain that the buying interest, the buying demand for these properties is there. Interest rates continue to go up. They've actually dipped a little bit this week. I think the last number I saw was 5.5%, 5.51, according to Fannie or Freddie Mac. But keep in mind that's still almost twice where we were a year ago. So the net effect of home prices going up because there's been more demand than supply, and because these interest rates going up, and because we're now at a seasonal peak, again, according to the numbers we're seeing from Altos Research, that's hampered affordability. So as I mentioned earlier, somebody who's buying a home today, who would have been looking at that same home a year ago, the combination of interest rates being twice what they were last year and home prices being up 15 to 18%, depending on where you are in the country, means that average mortgage payment is up 40 to 50%. And I don't know about you, but I didn't get my 40 to 50% raise from last year. So that's a pretty meaningful number for people that are looking to buy houses. We recently announced or issued our quarterly affordability report, and what we found is that based on our affordability index, and they use some industry standard debt to income ratios of 28% on your mortgage payment, and a 30-year fixed rate loan with 20% equity. Virtually nowhere in the country. There are a few markets in the Midwest where things are still affordable, but based on those criteria, just about nowhere in the country is affordable, and almost everywhere is below their historic levels of affordability. So that's the impact those rising interest rates have had. And I do believe the Federal Reserve intended that to be the case to cool down an overheated housing market, which of course does have an impact on overall inflation. What's happened because of that affordability is we've seen sales drop, as I pointed out earlier, but we've also seen, according to Altos, immediate sales drop. And immediate sales are a property gets listed and within 24 hours it's under contract. And we know that some of this is due to pocket listings from agents who get a buyer teed up before a property gets listed. But it's also just because the demand has been so strong that people have been waiting to pounce and are pre-qualified to make immediate offers, and because cash buyers have accounted for a very high percentage, a higher than normal percentage of purchase activity. So cash buyers have been ready to jump in and get these properties. But as prices have gone up, as interest rates have gone up, as affordability has gone down, we've seen the percentage of immediate sales drop as well. What's also interesting is that we're seeing price reductions come back, and they're doing it in a way that is accelerating faster than normal seasonal trends. So that dark red line you're looking at right now is price reductions on properties that are listed. Now, normally you'd be looking at about 30 to 33% of properties having some sort of price reduction at this time of year. As you can see, the beginning of the year, nobody's reducing prices really. The rate of acceleration of home price reductions is much more rapid than what we would normally see based on seasonality. So again, we attribute that primarily to the rising prices that are due, the rising interest rates and the lower affordability. So I believe you'll continue to see more properties with price reductions as we go through the year. And again, the normal curve is as the year ends, you start to see those price reductions come down a little bit. Two things to keep in mind. One is that as we go through this year, we're likely to see more rational, less aggressive list prices happen, which will lower the number of list price reductions that we have. The other is that there's a difference between a list price reduction and a property price decline. So if you're selling a house for $1 million and you reduce it to $975,000, that probably is still more than you would have got for the house a year ago. So it's not necessarily that the price of the property is declining, it's just that the list price is coming down. So keep that in mind when you read these numbers in the press. All of this, I believe, is starting to show signs of weakening demand. Not that demand is awful, as I mentioned earlier. There are still some demographic trends pushing people toward home ownership. But if you look at what we're seeing now in a number of different metrics that I watch, This one is the purchase loan application index from the Mortgage Bankers Association. The yellow bar is 2022. And what you can see there is 2022 loan applications are declining, have been declining since early in the year, and are running below what we saw in 2019 and 2021. They're also running behind 2020, but 2020 was such an anomaly because of the pandemic that I almost don't count those numbers. They were just all over the chart. But compared to the last two relatively normal years we've seen in home buying activity, we can see that purchase loan applications are much lower. We're also seeing pending home sales trending down. So you've probably seen press reports about pending home sales. They tend to look at things on a month-over-month basis. I tend to look at them more on a year-over-year basis. And we've seen a full year now of monthly pending home sales where those pending sales were lower than they were a year ago. So again, pending sales are properties going under contract, which is usually a pretty reliable indicator of what we're going to see in the sales numbers in subsequent months, and they've been trending down. And for those of you who look at California as being sort of a bellwether of what's going on in the housing market, if you look at existing home sales on a year-to-date basis, California sales are off almost 9%. If you're looking at May compared to a year ago, it's off 15%. So California sales are down. Prices have remained very, very strong, too strong probably. But if we were looking at these numbers a few months ago, you would have seen double-digit price increases. And now we're looking at something just below 10%. I think you'll see that index continue to go down. We're looking at the unsold inventory up significantly. It was at about a month and a half inventory supply a few months ago, now up over 2.1 months. I think that will continue to go up. And I have to chuckle at this one. Days on market is up, almost 29%. So it's taking almost 9 days to sell a property, which historically speaking is crazy low. Usually you're looking at anywhere from 2 weeks to a month or more to sell a property. So 9 days is still just, crazy on the low side, but still up significantly from where we were. So if California is predictive of the rest of the country in terms of home sales, all of these things are pointing toward demand weakening from where it has been. So what's going on in real estate investing? Well, we look at real estate and we look at basically two types of real estate investing. We look at fix and flip investing. We look at buy and hold single family rental investing. The flipping market is one of those good news, bad news markets. So flipping, both in terms of sheer numbers of flips and the percentage of flips as it relates to overall residential sales, are the highest they've been since we started tracking the data back in 2000. So highest numbers literally in 22 years, to where in the first quarter of this year, almost 10% of all residential sales were fix and flip sales. And you can see that the number of single family units flipped in the quarter was almost 120,000 units. So very strong appetite for people to buy these properties. Strong level of, speaking from the same page in the dictionary here, our definition of flip is any property that was bought and resold within a year. It does include in today's numbers sales by iBuyers, and we believe those numbers are skewing the data a little bit, both in terms of the raw numbers and in terms of the prices and the days on market, which we'll get to in a second. Profit margins have been compressed. So if you're looking, and we look at gross profit and the gross return on investment. The gross profit is simply how much the property was sold for, less how much the property cost to buy. And you can see that gross profit was better than it was the prior quarter, but it was lower than it was a year ago. It was somewhere between 45 and 50%. The gross ROI dropped significantly, and that dropped to about 26%, 27%. And that's simply because home prices have started to accelerate at a slower pace than they had been previously. Now, these again are gross numbers. They are not raw numbers, or they are not net numbers, which means we don't take into account financing costs. We don't take into account repair costs, labor costs, and we know those latter two have gone up on a year-over-year basis. But flippers across the country, on average, we're still getting a gross profit of more than $60,000. Obviously, higher numbers than that in markets like California, lower numbers than that in lower price markets like Alabama and Indiana. But these are what the averages were. Average days to flip, after dropping pretty significantly, came back up, and this is one of the sharper increases we've seen of late, about 162 days on average to flip. And again, that does include the iBuyer segment of the market. We're eventually going to be able to parse those and kind of separate those from traditional fix and flips, because as we all know, they don't do a lot of fixing. They just basically pursue an arbitrage model, try and buy a property that's more or less move-in ready, do some minor cosmetic work to it, and then get it out on the market. But that's what's been going on in the flip market, the fix and flip market. So still a pretty healthy market, still decent margins. On a percentage basis, not as strong as they have been, but flippers do really well in markets that are characterized by very strong demand and rapidly appreciating prices. So if you're a fix and flip investor, I'd encourage you to be more careful today, more measured as you're looking at properties to purchase. The good news is you probably have a little bit less competition than you did in months prior. And for cash buyers or buyers that come in pre-financed are at a huge advantage over consumers who are looking at significantly higher financing costs today. We did a report on the single family rental market earlier this year, and what our data showed is that gross rental yields in year one, and that's important, declined in 72% of the market studied. And what we define as that gross rental yield is your annualized gross rental income in that first year divided by the median purchase price. And so rents basically didn't go up as fast as home prices did in most markets. And over time, that will improve as you're only buying the property once, and you'll be able to see the rent yields improve on a year-over-year basis. But in year one, we saw gross rental yields decline across the country. And that was because home price appreciation outpaced rental rate increases. We saw home prices rise by 15% in over half of the counties we studied. Rental rates only rose that high in about 33%. Yields dropped in 75% of the counties where home prices were above $250,000, and in 2/3 of the counties where sales prices are below $250,000. So you're more likely to see your percentage yield decline in higher priced markets than you were in lower priced markets. But you also saw higher yields, in addition to that, you saw higher yields in 8% and above in markets where prices are below $250,000, but below 6% in markets where prices are above $500,000. That said, even though your percentage yield might be lower in those high-priced markets, your gross revenues might continue to be higher, just because you're charging higher monthly rent on a $500,000 house than you were on a $150,000 house. So again, not all bad news, but just some observations we made from what we saw in the numbers. And no surprise at all, but rental rates and home prices outpaced wage growth virtually everywhere, and that's made affordability a real issue. Something to keep your eye on as you go forward is the government is watching affordability pretty closely, and so there's a lot of anti-investor sentiment in both state and federal, and to a certain extent local market governments, and it's important to keep your eye on what's going on there, and to stay in touch with your state and local representatives to make sure that they're not doing something foolish to disrupt the investor market, which is such a critical component of the overall real estate ecosystem. We do believe we will continue to see stronger and stronger opportunities in the rental market as people are priced out of the purchase market. So again, even though your short-term yields might not be as strong as they were a year or 2 years ago, Still lots and lots of opportunities in the rental market, but again, pays to be prudent, pays to be a little bit patient. Make sure you're buying smartly and you're buying in markets where rental rate growth continues to be moving in the right direction. A lot of investors buy foreclosure properties because they represent good value or because they're excellent fix and flip or fix and rent opportunities. And we've seen foreclosure activity hit record lows over the last couple of years. People have been watching the forbearance program with the notion that people in forbearance would ultimately wind up in foreclosure. That simply hasn't been the case. There was a fairly well-known East Coast economist whose work I always follow because he usually gets things wrong, and I get a chuckle out of that. And he had predicted that about 35% of all borrowers would wind up in the forbearance program. And had he been right, that would have pretty much bankrupted the mortgage industry and caused all sorts of havoc in the real estate market and the overall economy. So fortunately, he was wrong. The peak was about 8.5% right after the forbearance program was introduced. And for those of you who may not be all that familiar with it, this was a program the government put in place at the very beginning of the pandemic. And it would give people the opportunity to miss mortgage payments without getting into default and foreclosure, and give them a long time to get their finance back in order and hopefully get back to paying their payments on time. So at the peak of this, about 4.5 million people were in the forbearance program. All told, about 8 million people have been through the program. There are less than 400,000 still in forbearance. So it's been a remarkable program in that as people have left, they've left with a plan in place 83% of the time. In fact, almost 19% of them never missed a mortgage payment, even while they were in forbearance. Another 11% of them had their loans reinstated, which means they made a lump sum payment of whatever payments they missed and then continued to make payments after that. 17% left without a plan in place, either a loan modification, a deferral plan, a reinstatement plan, or paying off the loan. About half of those, according to the mortgage bankers, ultimately did enter into some sort of plan with their mortgage servicer, and the other half went up back in forbearance. Less than 1%, in fact, just over 0.5%, have either defaulted, done a deed in lieu, or a short sale. So the performance of this program has been nothing short of extraordinary. And about 83% of the people that were in a loan workout or deferral program have also remained current after they left. To put this in perspective, during the Great Recession, if you were in a loan modification or a loan deferral program, you only maintained current payment status about 50% of the time. So 83% is just off the charts. And Fannie and Freddie basically are getting over 90% current payments. So it's just been a crazy successful program. But what that means is almost none of these people have entered into foreclosure. And in fact, if you just look at delinquency numbers, they're actually back to normal. We saw them spike, as you can see, the green bars jumping up the page on the right-hand side of this chart. And that was basically people who were in the forbearance program. So they were 90 days past due on making their payments, even though technically they weren't delinquent or in default because of how the government program was orchestrated. But if you look at what's been going on quarter over quarter, and these numbers again are from the MBA, you can see that we're now down to about 4.1% delinquency rates, which is actually lower than we were back in 2006 before we entered the Great Recession. And new delinquencies are as low as they've been in the last 50 years. So delinquency rates on loans today are back to normal. We will continue to see the 90+ day category decline as people exit the forbearance program, begin making those payments again. But with normal levels of delinquency rates, we're seeing foreclosure activity still remain significantly lower than normal. This is for monthly foreclosure starts, quarterly foreclosure starts from ATTOM. And as you can see, we peaked back during the early stages of the financial crisis back in 2008. And right before the pandemic hit back in 2019, early 2020, we were still below normal levels. Normal levels, you have about 1% of loans in some stage of foreclosure. We were just below that prior to the pandemic. When the government moratorium went into effect and the forbearance program went into effect, we went down to historically low levels of foreclosure starts. We've seen them come up on a somewhat regular basis. Our preliminary findings for Q2, and we'll be releasing that data in the next couple of weeks, are continued increases on a year-over-year basis. But we're probably not going to be back to normal levels until sometime in 2023. So the people that were anticipating or selling you something based on the notion that we're going to have a huge wave of foreclosures, candidly, were just wrong. Something very important for you as investors to keep in mind if you're interested in buying foreclosures is how different this cycle is going to be from the last cycle in terms of when to buy and what kind of foreclosure assets will be available to buy. During the Great Recession, the majority of properties that entered foreclosure ultimately went back to the lenders. So the buyers couldn't sell them because they were underwater on their loans. Not the buyer, the owner couldn't sell them because they were underwater on their loans. The lenders weren't pricing them to sell at the foreclosure auction because they didn't want to take the loss. So ultimately they became bank repossessions or lender repossessions, or what the industry calls REOs. So your role as an investor was basically to wait for these properties to get back to the banks and then try and purchase them there. That's not going to happen this time. There's a record amount of homeowner equity, about $27 trillion in homeowner equity. And in fact, according to our numbers, about 90% of borrowers currently in foreclosure actually have positive equity on their homes, which is way different from the last cycle when a third of all homeowners were underwater. In fact, something like 50% of borrowers in foreclosure have more than 40% equity in their homes. So the likelihood is these properties will be sold in the early stages of foreclosure before the auction, and what gets to auction will sell at the auction. My contacts at auction companies tell me that their sell-through rate right now is about 70% on the properties coming to auction. That's about twice the normal level. So between properties being sold prior to the auction and properties being sold at the auction, very, very little inventory is going to become REO inventory. So if you're looking to buy these properties now, the way to do it is to approach those distressed homeowners while they're in the early stages of foreclosure, or to be ready to pounce at those foreclosure auctions, not to wait for REOs. Big, big difference from prior cycles. So summarizing all this, what are we seeing coming in 2022 for the rest of this year and into 2023? The economy continues to be strong, but there's a very real possibility, and in my mind, there's a pretty strong probability of a recession in the next 12 to 18 months. I do believe it will probably be a fairly short-lived recession. I don't think it will be a recession that decimates the jobs market, because there are still more jobs available than there are people looking for work. And that's not just in the service sectors anymore. It's really pretty much across the board. And I don't think it will be a very long recession, but it will be a recession. How long it is, how severe it is, will also have an impact, by the way, on the foreclosure market. And if you're looking for areas of vulnerability, one of those areas might be markets that have a high percentage of FHA loans. FHA borrowers as a group tend to have higher debt to income ratios, lower cash reserves, less equity, which means they're more prone to problems if you do have a bit of an economic downturn. So if you're in markets like in Florida, in Tampa and Orlando, if you're in Philadelphia, parts of New Jersey, markets like Houston and San Antonio and Texas, Riverside, and some other markets in California that do have a high percentage of FHA loans, might be some opportunities there as some of those borrowers have a hard time making ends meet in a downturn. Rising mortgage rates and home prices and inflation is a triple whammy, really making affordability a problem for a lot of prospective home buyers, especially first-time home buyers who don't have that equity to trade in on the next purchase. So we are likely to continue to see sales volume slow down, and price appreciation is likely to follow. I am not calling for price declines nationally. I do think we'll have some local market price corrections, I do not believe, nor does anybody whose work I respect, believe that we're looking at a housing bubble. But I do think you'll probably see price corrections in some markets that were overpriced in 2021, particularly at the high end of the market. If you're a fix and flip investor, and to a certain extent, if you're a single family rental investor, this is a good time to be sharpening your pencils when it comes to purchase price and repair estimates. That 20% year-over-year price increase trend that we've seen for a couple of years is over. So you can't afford to make mistakes right now in your property valuation and your repair estimates, because you won't be able to paper over it with crazy annual price increases. A lack of inventory and weakening affordability is likely to result in a higher demand for rentals as people vote themselves off the home buyer island, if you will. So lots of opportunities there. And foreclosure activity will probably continue to increase steadily, but we're not going to have a foreclosure tsunami. We're probably not going to see normal levels until sometime in 2023. But again, as I mentioned earlier, if we have a strong recession, it could change that forecast significantly. That's my outlook. If you're looking for more of this, just visit our website and look for the Market Insights section. We post this kind of information, free reports all the time. Feel free to reach out, follow me on social media. I'm on both Twitter and LinkedIn, where I'm always up commenting on this kind of stuff. And again, I want to thank Jeff and the team at RCN Capital for having me today. I would be happy to answer any questions if we have them. If you can take, I don't know if I have to turn this back over to you, or if you guys can take control of the screen. But happy to answer any questions we might have.
Yeah, we'll have the team bring up some of the questions. But Rick, I made some notes, and I would love to dive into a few of your slides. I sort of went in chronological order. In the interest of time, I'm going to limit it because I'm kind of a numbers geek. I would love to get into some of this stuff because it's so interesting to me how the numbers tell the story of both past, present, and future of where we're going. And many times these numbers are absolutely correct, and history repeats itself over and over and over again. If you have the ability, I'd love to go back to slide number 12, where we were talking, you were talking about liquidity, and I would love to understand how liquidity comes into play as it pertains to slide 12. And I don't know if you can bring that back, or we took away your toys.
I actually clicked over to you as the organizer. I'm now, okay, let me go back to this. And so slide 12, I believe, is this one you're talking about, Jeff?
Yes. So it's super interesting to me how the Fed has played a role in tamping down inflation, trying to avoid a recession. But when that liquidity comes into the marketplace, how that has affected the chances of recession, and overall, how much more money there is in this system today than as we went back over the years. It's got to have an effect, I would think.
Yeah, and probably the easiest way to talk about that is that we've gone from an environment of quantitative easing, where the Fed was investing billions of dollars into mortgage-backed securities, to where we're getting into quantitative tightening. And this chart was really talking mostly about the Fed funds rate, but simultaneously, while they're raising the Fed funds rate, they're also exiting that securities market. And that takes some liquidity out of the equation. And it gets really interesting, Jeff, because as you know, the secondary market in particular and the capital markets are extremely rate sensitive. And that becomes a challenge for particularly for private lenders, but I guess a lot of your competitors more so than RCN. in terms of finding what they need to be able to fund the loans that the clients, your borrowers want. So it'll be interesting to this, but I think the where I would go with this is that, yeah, it's good. The cost of borrowing is getting more expensive, and I believe the Fed is trying to, frankly, siphon out some of the capital from the market because there may have been too much out there.
Yeah, super interesting to me. Now that they've turned off the spigot, and at the end of the day, they've stopped the purchases. They're letting the mortgage bonds run off, which is having an effect as well. And it's showing up in higher interest rates, not only for what they're doing, but for the appetite for the securities, as you mentioned, without a doubt. So another item I wanted to speak on was new homes sales falling. And I was interested to hear, and I didn't write down what slide that was. It was a couple slides ahead. You had talked about new home sales falling, but I'm interested, how much of that is because of lack of the builders to be able to get the supply into the marketplace versus a business decision? Do we even know?
We can speculate, and I'll refer to another chart to kind of try and illustrate that. If you're looking at supply coming into market, that would be the red area on this chart. And so the inclination would be to say it's just taking builders too long. They can't get the supplies they need, they can't get the labor they need, and they can't get these houses built quickly enough. And that's probably true. But they're selling a ton of properties that are under construction, and they're selling a lot of properties where they've just got the permit signed and they haven't even started to build. So, to a certain extent, they're selling futures, if you will. Mm-hmm. So I don't think we're seeing lack of new home purchases because it's taking too long to get properties to market, because a lot of these purchases are actually taking place prior to construction being completed. And that's very different from normal activity. So it's a very logical question. I really do believe it's more that, new home prices on average have been somewhere between $50,000 and $100,000 more than existing home prices. And as rates doubled, I think that just knocked a lot of prospective buyers out of the market. So we have seen contract cancellations increase when some of the public builders have released their quarterly reports, not to crisis stage, but certainly much higher than what we saw a year ago. So I do think it's more buyers deciding not to buy than it is builders not being able to deliver product.
Interesting. I'd like to move to, actually, one more comment on this I had written down, which was population growth in the United States overall. As you were talking about this slide, I was thinking to myself, looking at the overall numbers here, and you go back all the way to 1973, and I'm sitting here and I'm looking at the chart and I'm thinking to myself, wow, he goes all the way back almost 50 years, right? And the numbers, with the exception of the run up to the Great Recession, have remained almost constant. How does that make sense when population growth, my guess, has increased over the years? And maybe that's what put us in the pickle that we're in now with the lack of supply.
So builders had built at a fairly consistent level, as you pointed out, for 30, almost 40 years. Then they overshot the mark heading into the Great Recession. And one of the reasons we had the Great Recession is because we did have an oversupply of new homes, and they wound up competing with the prior year's new homes, which were now suddenly in foreclosure and were twice as big and half as expensive. And then they went into an underbuilding market. The only reason that things aren't even worse is that US population growth honestly hasn't been all that strong over the last decade. And it actually got even slower over the last 5 years or so as immigration numbers slowed down. So builders have been building at a deficit really probably at least since, I don't know, 2012, last decade, and have a lot of catching up to do. They may not have been building enough to meet full demand prior to the run-up in the housing boom and bust, but it got exacerbated over the last few years. What's been also interesting is we've seen home ownership rates, which probably got too high during that period, 2006, 2007. They've gone up probably 50 basis points over the last few years to where we're looking at, close to 65% home ownership rates. So we would probably have higher home ownership rates if we had more inventory available, but they underbuilt, they haven't caught up. And to your point, they probably were already underbuilding relative to population growth even before this boom and bust cycle.
Super interesting. I'd love to go to, we're going to run out of time here, but I would love to go to slide 27, which is, I wrote down the question, why, which basically, I'm sitting here and I'm looking at this and I'm thinking to myself, why all of a sudden has flipping taken off? Now, we have data here at RCN Capital where I could be subjective, but I think you've got way more insight than I do as to why the short term is really taking off. And to your point about iBuyers, boy, it's a head scratcher. I wonder how much of this, because I know our flip business is way up, to customers. Our not only month over month, but year over year, we're doing way more short-term loans than we were a year ago to the flippers of the world. But DC, the debt service coverage ratio, the rental loans have come down as it's tougher, as you pointed out, it's tougher to price these out now. But these charts really show an amazing spike, and I just ask why.
If you go back a full year, you look at the last 4 quarters, you see a pretty straight line heading up and to the right. And again, I'll go back to a comment I made earlier. Flipping tends to take off in markets that are characterized by high demand, low inventory, and accelerating prices. And those 3 things were really how I would describe the housing market over the last year to 18 months. So it's just kind of a perfect storm for fix and flip investors during that period of time. The demand is so strong that if you're able to buy a property, you're going to be able to sell it. So I think we also had a lot of people, we probably had a lot of new people entering the market and doing 1 or 2 flips a year that added into it. The fourth quarter number or the first quarter number, those 2 numbers, I really do think were probably a little bit artificially inflated by some things that went on in the iBuyer market. Zillow, for example, exited the market, their iBuyer, their Zillow offers program, and they had thousands of properties they had to get rid of to exit that market. And those would all show up as flips in our data because they were bought and sold within a year. Open Door announced record numbers of sales for them last year as well, and most of that was in the second half of the year. So I think when the dust settles and we have a chance to go back and look at this and try and figure out what percentage of this was, an iBuyer percentage, if you took 10,000 properties out of the first quarter and attribute those to iBuyers, that growth rate looks a whole lot less ridiculous than it does right now. And I do think there was probably some of that inflated these numbers a bit.
Interesting. I'd like to go to slide 35 and talk for just a minute about delinquencies.
Sure.
I'll wait till you bring up the slide there. I just bring this slide up because you and I have been on panels together for the whole length of the pandemic, right?
Yes.
And the narrative from the audience, who's generally investors, never changed, which is, well, you guys can say what you want, but I know what's coming.
Yep.
And I can't wait to get there. So I just wanted to bring it up one more time because it seems like the verdict is in, and there's really not much point for discussion anymore regarding the coming wave of foreclosures.
You would be, I was going to say you'd be surprised, but actually you wouldn't be surprised. As I do these sessions, as I go to in-person events, I am still getting grabbed by the lapel, either physically or virtually, by somebody who says, yeah, I see what you're saying with the numbers, but you don't get it. You don't. I see what's happening in my market, and my market maybe is different from everybody else's. And my lender just gave me 2 new properties to list that are bank-owned properties. I'm going, great. There's 140 million housing units in the United States, and you just got 2. So let's call CBS News and make sure they're on board. If you look at these numbers and look at the way they're performing, again, in a normal market, you have about 4% of loans that are delinquent. You have about 1% of loans that are in foreclosure. We haven't had delinquency numbers this low since the latter part of 2019. And before that, it really wasn't until the early 2000s. The lending standards have really improved so much since the boom and bust that virtually everybody's making their payments on time. When you see 12% of people in forbearance being able to pay a lump sum for whatever payments they deferred, when you see 17-18% of the people in forbearance never missing a payment, just got into the program to hedge their bets, and when you see this green bar shrink by half over the last year in terms of the number of loans that are delinquent, 90 days plus, we're getting back to what is a normal, very healthy market in terms of delinquencies, and there are just no signs, no indicators anywhere that a wave of foreclosures is coming. It feels to people in the default business like things are getting really busy because they're going from 0 to something, but there's just nothing in any of the numbers that indicates a huge wave of foreclosure activity anytime soon. And again, I'll point out that properties entering foreclosure doesn't necessarily mean they're going to get foreclosed on. A lot of these are going to be sold before that foreclosure auction, and most of the ones that get to auction will be sold before they go back to the lenders. So it's a very, very different dynamic.
Yeah, and I wanted you, and that was my last thought before we wrap here, which was slide 37, which this doesn't get talked about much. It really doesn't. In the mortgage circles, in the borrower circle, this number doesn't get talked about much, but the number, I shouldn't say number, the percentage of equity that has been gained year over year, I mean, it's breathtaking how much equity is in the homeowner and investor, I might add, portfolio today. I'd love you to just touch on that one more time.
Yeah, there was very little opportunity for a soft landing for people that own properties back in 2007, 2008 when the market turned. You had that oversupply, twice as many properties as the market would normally handle. You had a lot of really bad loans that were out there, people that never should have got loans in the first place, people with negative amortization loans when they bought overpriced properties. There was a story, I'm in Orange County, California, there was a story in our local newspaper about a quote unquote investor who owned 8 properties that were all in foreclosure in the city of Santa Ana. And if you read the story, you found out this investor, again in quotes, turned out to be a cleaning lady. who made less than $40,000 a year, but somehow had mortgages on 8 separate investment properties. And you know, the loan officer that was writing mortgage number 8, I have to wonder, you know, why that person's not in jail somewhere. But that was the kind of craziness we had going on that precipitated the last wave. The CFPB put these ability to repay rules in place, which has just dramatically improved loan quality. You have all this equity out there now, which you didn't have before. Lenders are not motivated to repossess properties. They don't want properties on their books. So they're really motivated to see these things go before they get them back. And there's such strong demand and there's so much equity that these borrowers have that it just, the likelihood of seeing a lot of these properties go back to being bank owned is just minimal at best. We never saw as high a percentage go back to the lenders as we did during the Great Recession. That was an anomaly on its own. And I suspect this time the anomaly will be we'll never see a lower percentage go back just because of the supply-demand imbalance and because of the amount of equity that's available.
Well, great way to leave it off. Folks on the web here, I hope you enjoyed this. We will make this presentation deck available to anybody who wants it. Just email us here, info@RCN Capital. Rick, thank you for making yourself available. Thank you for putting the data together to the investment community, really getting down into the granular nuts and bolts of things, especially in the fluid times that we're in with the rising interest rate market that we're in. It really goes to the underpinnings of what we all do here. And gives folks a lot of confidence about our industry. And I can't thank you enough on behalf of myself, RCN Capital, our investors, and the industry at large for all that you do. I really appreciate it.
Well, my pleasure, Jeff. Look forward to doing it again sometime, and I'm sure I'll see you out on the conference circuit.
Without a doubt. We'll leave it at that, folks. Have a good afternoon. Thanks so much.